Hi everyone, this is Chart Sniper. Welcome to Options Training Overview session from Eagle Investors. Eagle Investors has a very comprehensive hands-on and affordable trainings in its education program. The main goal is to enable all the members of Eagle Investors to ramp up quickly on options trading and all the strategies that a trader can do with options so that he can use the right strategy at the right time to make decent profits without much losses. So in this options training overview session, we'll mainly go through some basic concepts in understanding what are options, how they are different from stocks, and what are the various components of options, what option price constitutes, and how option price changes with stock price. Some frequently asked questions about most what to trade, what to buy, because there are so many options when it comes to option contracts. Typically, when you are dealing with a stock, it's either a buy or sell. But there are a lot of things when it comes to options. So, some frequently asked questions by traders who do not know much about options. And we'll give you a brief overview of all the training sessions that Eagle Investors offers when it comes to options training. Let's start. What are options? So options are some kind of agreements that are created on top of trading instruments. A trading instrument can be a stock, a currency, a future, or any other instruments that is tradable. So these agreements, once they are created, they are released into the open market. There will be people bidding for these agreements and asking for these agreements. So these agreements themselves trade as some kind of stocks or tradable instruments themselves. But the main difference here is an option cannot exist without an underlying stock because that's why these are called derived instruments, derivatives. So whenever some kind of options needs to be traded in the open market, there has to be someone who sells these options. Those are mainly called option underwriters. When an option underwriter sits on a lot of stocks that they would like to sell, they typically write these agreements and sell these agreements, hoping that they can make some profit by collecting from the premium collected by selling these agreements. Option buyers buy these agreements from the sellers and they pay a premium. So, for example, if you talk about builders, home builders, home builders builds a lot of houses, and assuming he has piled up a continuous supply of inventory of homes that he needs to sell, he can enter into agreements with potential buyers to buy that home on a future date, say in January 2021 or December 2020 or January 2022. So these are the agreements that give some peace of mind for the seller of the homes or home builder, and he can collect some advance from the home buyers. When the home buyer doesn't want to buy the house or the house price is kind of or in line with market prices at the time of agreement maturation period, then the buyer gains the advantage of keeping that premium or the advance. That's a simple example of a call option underwriting. So typically, a potential buyer of a call option tries to use that agreement to get into a leverage position, uh, especially when he's thinking that the market price might increase for that underlying. The other type of option is a put option. Put options is mainly used synonymous to buying a hedging or buying some insurance. It's like we buy car insurance. So there will be some insurance sellers like Progressive or Geico who sell insurance to us and we pay premium. It's a very, very profitable business for the insurance companies as long as they make sure the number of occurrences of incidents is less. So you can compare put options to that kind of thing. There will be still some big players who will be writing put contracts and put agreements and selling it to potential buyers of put options. So these things are covered more in depth in the trainings that the options basics training, very in depth. So this, at a very high level, that being listed here so that you get an understanding of what is being covered and get a gist of it. So the option frame prices, the contract prices, the agreement prices, the value of this agreement changes when the price changes in the market. As home value increases, the agreement to buy a home, that value also increases. And as home value falls, the price of that agreement also falls. So that's at a very high level, what are options and what are the different types of options and some real life examples on what they could mean. This shows the profit potential of a long call and this shows the profit potential of a long put. Now looking at what option contract constitutes, what are the various components of the option contract. The underlying code for an option contract or the agreement, if you want to call it that way, is as shown here. So the first one is a dot, which kind of distinguishes that it's not a stock, it's an option, and the stock itself, the expiration date in YYMMDD format, whether it's a call or a put, and the strike price. So each component of it is defined here in detail. So the expiration is the future date on which the agreement can be exercised. Typically, there are monthly expirations, but uh, for the next couple of months, there will be weekly expiration also. So for this contract, there will be a price set in the open market, and typically people, depending on the supply and demand and the expected potential events that will happen, which will fluctuate the price of the underlying, the option value also increases or decreases accordingly. So with these many additional things introduced in an option agreement, there will be plenty of option contracts available for a single underlying. So the complexity increases exponentially when you are typically doing option contracts or option trading from stocks trading. When you're new to options, it's a lot of information to absorb. So all the different option agreements that are tradable under an underlying option will be in the option chain. It displays all the expirations and strikes available for trading. A lot of option geeks can be added to this chain and customize the display. After getting this brief understanding of an option agreement, what are the various components, let's move on. How do these options get priced? Typically, the option premiums that, if you have to break it down into major components, there's something like an intrinsic value and an extrinsic value. So, intrinsic value is the difference between the agreement price, which is the strike price that is there in the agreement, and the actual current market value. So, for example, if you, as a home builder, you plan to sell the house in January 2021 for 100K, the current market value of house is say 150K, the intrinsic value of that option. Just by entering into that agreement, you get the right to buy that house at 100K on January 2021. So immediately by using that option or exercising that option, when the market value is 150K, you are leveraging 50K profit by exercising it. So that is called the intrinsic value. So current market value subtracting the agreed strike value. Anything that is more than the intrinsic value is extrinsic value. So extrinsic value is the most dangerous thing that most beginning traders of options will ignore. And its understanding of this extrinsic value is very critical for the for making money in options trading and not losing it. So the extrinsic value is always working against our main goal of making money. The extrinsic value, if you have to further break it down into more things, it can be at a high level broken down into the implied volatility and time decay. Each one of these that is mentioned in this slide is discussed very in depth in the training sessions. I'm just giving it a very high level overview here so that you understand the gist of it and what is very important to understand. If you do not understand implied volatility in depth or time decay in depth or this extrinsic value in depth, then this basics options training will certainly help you reach that level where you are very comfortable in understanding what is that you're paying when you're buying an option, and is it kind of very high or very low, and how exactly to kind of make money out of it. So it's very important. So the next main important thing that you'd like to understand is when a stock prices changes, how option price changes. So option price typically is determined by the supply and demand, and also where the stock price is, what is the stock's volatility is, and a lot of other parameters. So churning up all those numbers, most of the trading platforms provides a simple way of tracking how much an option price changes with a change in underlying price or change in volatility or change in how many days are there for expiration. So delta, gamma, theta, and vega are some of the geeks that will help calculate the option price when the stock price reaches a certain level. So each one of these might mean a lot of different things, and these also help us to make the decision on what option is better to trade in what environment. So we'll go in depth in the trainings on each and every one of these and what exactly it means, how we should select the option contract based on the values of these values in different circumstances when volatility is high, when volatility is low, when our confidence level is high, when our conviction is high, what exactly is the delta that we have to choose. So these geeks are important to understand, and we'll go through these a lot depth in the training sessions. So next, coming to the frequently asked questions, these are the questions that a beginner option trader must ask, and they also struggle with it, identifying it. So what option strike should I select? What expiration should I choose out of all the available expiration? Are the option premiums cheap or expensive now? Should I buy it, say, now, right now, or should I wait for a few more days for the perfect time to buy the options? Which option strategy should I use? Should I just buy a call, or should I sell a put? Should I buy a call spread? Should I do a calendar? So there are different kind of strategies. Uh, each strategy used in certain circumstances depending on all the different variables of implied volatility and the option prices and the expirations and all. So it certainly helps to understand which option strategy should I use in which circumstances. Is there enough liquidity in the options that I'm playing? If there is no liquidity, then the bid and ask gap will be very high. Sometimes for some penny stocks, even you may not find a buyer when you want to sell them. So it's very important to understand the liquidity, open interest concepts thoroughly so that you don't make a mistake of paying or trading options with a high bid ask gap. How earnings impact my option premiums, how some unleashed events, unleashed meetings or investor meetings will impact the options premium. So understanding those is very important in determining the right time of entry and exit. For people, the main purpose of options, creation of options by big players was to hedge, like we pay car insurance premium to kind of hedge the value of our car. Similarly, the options were mainly introduced to kind of hedge the stock holdings of position against some unexpected events. But later on, with the technology improving and the speed with which the trading platforms executes the contracts and the ease at which people can buy and sell these agreements in the open market, these are being used more for leverage purposes to kind of get more money in a short amount of time than if you trade stocks. So options will be very helpful in leveraging a potential move, upside move or directional move. If you have stocks, if you know for sure that it's going to certain levels, certainly you can use that stocks as a collateral to leverage your positions at no cost. You can ride the further upside move at no cost, enhancing your earnings or results. So can I use options as an alternative to holding stocks? Sometimes holding stocks becomes very risky, especially when it goes into the binary event. So options might be a good alternative to holding stocks into these binary events so that there is a defined risk. So all these questions are something that every option trader should ask or would have come across. And each one of these training, which to answer these questions, we have come up with a structured option training sessions, both for different types, different levels of option experts or beginners. So different levels of option training. So let's go through those options trainings. So we will be offering three different option courses. One is the option basics, which is the fundamentals and essentials of options training. This is very essential to understand what exactly is an option and what should you be aware of, what you must know before you trade options, start trading options. And then comes options popular strategies. These things you hear frequently a lot of people playing, and then some advanced strategies. So let's go into details of this each session and what is covered. So when we look at option basics, it's very important to understand what is the contract, what are the different types of options, and some of these things I have already kind of gave a summary of it in this thing, option premium, what it constitutes, implied volatility, IV, and geeks, and more details on calls and the profit curves. All these things that are listed here will be covered in depth. Each and every topic is kind of discussed in depth with examples so that you get a very in-depth perspective understanding of all these things. So these will be very important to kind of get going with options and also forming a very strong foundation for future option trading. So in this option basic session, we'll be discussing primarily the single-legged options, which is like a call or a put, not more than that. In the next session, where in the option popular strategy, we'll be trying to see how he can combine these call and puts in different ways, both in terms of the expirations or both in terms of the strike prices. So different variations of adjusting these legs, the expiration of those, the strike price of those leads us to various different strategies. These are called spreads, a vertical spread, diagonal spread, calendar spread, straddle, strangle. Almost all these things that you see on the left side involve two option contracts. One is a buy contract, one is a sell contract. The things that you see on the right is a butterfly strategy, which is a three-legged option. And out of all these options, we'll discuss which strategy is very good when the volatility is less, and which strategies is good when the when the volatility is very high. And what are the good strategies for day trading and swing trading? And we'll be discussing in this session some common mistakes and best practices to do when you're handling with these spreads. So each of these strategy spread, you'll get a cheat sheet on when exactly you need to use, how to manage these, how you can close these. So all these details will be discussed for each and every one of these spreads strategies. So the next strategy will be like advanced strategies where we'll be talking more about selling spreads. It's not about buying or paying premium, it's about selling spreads and collecting premium. This is what all the big players do to earn consistent money. It's about some very high probability setups. The premium collected will be less, but the probability of you succeeding will be more. So we'll be discussing iron condors and iron flies, unbalanced butterflies, some risk reversal strategies. Ultimately, when your portfolio kind of increases and when you want to reduce the net delta of the portfolio, then some delta neutral strategies that you can embrace, and also like some IV reversion strategies that you can use, especially during the earnings season or playing through the earnings. So what are the different types of earning play strategies and how you can hedge stocks with options, how you can leverage on top of it, option leaps, which are like some kind of alternative to holding stocks, a cheap way of holding stocks, and looking into options flow, which includes the time and sales information, the volume of the options that big players are buying, how to look into it, how to understanding it, and common mistakes and best practices. So these are the three different trainings, a very structured training that will give you end-to-end understanding depending on how much in depth you want to understand the options and trade them. So these are in a logical progression. Option basics will lead to option popular strategies, and then which will lead to option advanced strategies. So this is very fundamental. This is very essential. I would recommend people understand all these things in depth, what exactly they mean, which how to use them before they even start trading options. The next two are depending on whether they're doing swing trading or long-term trading, or they're kind of using options to protect or hedge their stocks. So all these popular strategies and advanced strategies will help in that context. So now coming to the point how you can learn these concepts. So the first option is private appointment with expert or private tutoring. There will be 1 hour or 2 hour sessions that you can uh, schedule with your instructor, and they will go through in depth these concepts in a private tutoring session and answer all your questions depending on at what level your understanding is. Certainly, the instructor can enhance your understanding from that level onwards to a more in-depth understanding, clarify your doubts, and or even go through these sessions in detail personally. If that's not an option, then there will be on-demand recorded sessions. These sessions are each session will be lasting 3 hours to 3.5 hours, and they'll be going in depth all these content and more in each of those training sessions. These trainings are published on Udemy courses, and they cost very less for the amount of knowledge that you're gaining. So these courses and the structure of it, and with examples and in-depthness and um, real-time applications of these strategies, all these are based on years of experience trading options. So this is a very cheap way of understanding around 10 years of my trading experience within 3 hours or 3.5 hours for a fraction of a profit that you'll make probably in a day or in one session. So exclusive discount coupons for enrollment into Udemy courses will be available from our Eagle Investor members. That's at a very high level a overview of the options trainings that Eagle Education Program offers for all its members to kind of improve on their understanding, come up with a very standard foundation, strong foundation for trading options, and especially trading options along with a good understanding of trading stocks and technical analysis will always help. So there will be a completely different set of courses for technical analysis of stocks, because when the entries and exits into the option contracts are completely dependent on the price of the stock, and they are very similar to buying and selling a stock. When exactly you need to buy, what is the technical analysis, what is the level that you have to come out of it, what is the support and resistance for each stock levels. S- so these understanding of strong stock technical analysis, which are available at a different set of courses. In the technical analysis we have 4 sessions there, and then on top of it understanding the options in depth will create a very complete education profile for taking the trader to the next level. Thank you for your interest in these options training courses. Looking forward for you to kind of utilize these discount coupons for exclusively for members and leverage on these learnings and improve your foundation and understanding of options. Thank you.